and welcome to Decoding the Childcare Business. How do you finance a childcare business? My name is Zuleika Hines. I am so excited you're here in this conversation. I want to thank you for helping us reach over 1,000 subscriptions. Today, the conversation is going to be about the money. How do we find the money that we need for our childcare program to be able to go from an idea to become a reality? Decoding the childcare business. Unlock the money to build your childcare. As many of you know, we have a disclaimer. The information presented in this episode is for educational and informational purposes only. It does not constitute financial, legal, or professional advice. Always consult with a qualified financial planner, attorney, or real estate professional before making any business or investment decisions. An investment in knowledge pays the best interest. Let's get ready. In a prior episode, we talked about financial methods. What are the SBA loans? We're going to dive deeper into different SBA loans. I personally was able to benefit from the SBA 7A loan, and I will talk how I went about doing it, my experience in obtaining an SBA loan, and some of the things that you need to look out for as well. Let's keep going. SBA loans explained. Okay, let's talk about the SBA loans because SBA loans are loans that are guaranteed by the government to be lent to small business institutions. But usually the lender will be a bank. It could be like a TD bank. It could be a JP Morgan bank. It could be your community bank that also has an SBA loan component to their business model. Not all banks are the same. There are some banks that have preferential SBA lending. There are certain banks that have a direct line to SBA lending, and those banks are considered to be SBA approved banks. That makes a difference because even though many banks can participate in the SBA loan process, not all banks are sanctioned or have a direct connection with the SBA funding component or capacity, and that's important. And let me tell you, I went to 9 banks before a bank said yes to me. And many of the banks that I approached had SBA component to them. What was the difference? The bank that I ultimately did business with, it was Commerce Bank at the time, later on to be known as TD Bank. That bank had a purpose to fund small businesses, and childcare businesses were already identified as businesses that have long stability, they have sustainability, they stay in place for 10, 15 years or longer, which is very good for banks. It makes them really happy to know that you have a long-term lease, and especially the lease is longer than the loan itself. So having the right lender is not just, are you an SBA bank lender, but how many SBA loans have you given in the last year? How often are you in this space? Is this a priority for you or just an additional feature you like to have in your profile that you're an SBA lender? It's important to distinguish between the two, folks, because it makes a difference to link to the right bank. So that SBA lending, if you're turned down by one bank, it doesn't necessarily mean that another bank will also turn you down. And that's one of the things I was very tenacious about. I was insistent on going after every bank that had an SBA arm and presenting my presentation, showing them my business plan. So it's important for you to have a business plan. And we haven't spoken a lot about a business plan in the past, and I will make that into one of our episodes about how you can put together your own business plan to present to an SBA lender, because they're going to ask for that. Even the Community Development Fund is going to ask for that. Now, there's 2 types of SBA loans. We have a 504 loan versus a 7A loan. Let's break down the SBA 504 loan. Then we're going to talk about the 7A loan, which is my loan. And we're going to then talk a little bit further about my experience with the loan during the process. What is an SBA 504 loan? It's real estate and major equipment. So if you have a real estate and major equipment, is great. Well, what do you mean by real estate, Ms. Zuleika? What I mean by real estate is you buying a multifamily home. The ground level is already zoned for a childcare center. You're going to open a group family daycare in the ground level. And then the major equipment can be your cribs, your furniture. It could be your desk, your chairs. It could be your shelving. It could be your outdoor equipment. The maximum amount is $5.5 million, and you could put down as little as 10%. Where do I get my 10%, Ms. Zuleika? I'm barely making through. We talked about the HELOC. We talked about the cash value policy. We talked about the 401k. The interest rate is fixed and mostly below market. And the loan terms at 10, 20, or 25 years. I'm of the school of thought to take the loan terms as far out as possible. Don't become a hero and say I want a 10-year loan, because although that sounds beautiful and aggressive, the business has its life cycle. It has its up and down. So if you take a loan for at least 25 years, you can prepay the loan for the most part, without penalty. And if there is a penalty, it's usually between the first 3 to 5 years. So you still have room there to prepay the loan within 10 years if that is your goal, but take out the loan terms as far out as possible. Now, they're provided by the CDC, which is a two-part structure. Like I shared with you, the SBA is not doing the lending itself. They're guaranteeing the loan. So the lender is going to go ahead and go through all the due diligence, collect all the documents, all the paperwork, almost as if you were getting a traditional loan with that SBA guarantee. And then they will go and reach out to the SBA to guarantee the loan. What is good about it is that there's more flexibility when it comes to your credit score. There's more flexibility in explaining in situations in your finances that traditional banks may not accept. And it provides you with a great opportunity to own real estate. Can you buy a business? No, you cannot buy the business. So if a business is like the childcare center already existing and you wanted to buy that business, it doesn't allow you to buy the business under this program. Is there any working capital? There's no working capital. So you're getting this money for what? Buying the real estate, the equipment, a low 10% down. Most of the time it's fixed. And the reason why it's fixed is because they can collateralize your real estate. They're going to lien your real estate. Of course, they're going to give you a fixed interest rate. Your collateral is your real estate. You could take a term loan for 10, 20, 25 years, and the bank guarantees the loan. God forbid you don't pay or something happens unforeseen that you're not able to meet your side of the responsibilities and requirements of the loan. Great product, great program, and something that you can definitely use to get that building. How about an SBA 7A loan? The SBA 7A loan was what I needed because I was leasing a commercial space. It had 3 walls. I had to build the 4th wall, called a demising wall. A demising wall is a wall that separates you and another vendor. And it has to be fire rated, it has to have a level of thickness, it has to meet certain code requirements. So I had to build that demising wall that separated the other tenant from myself. It also was great for me because I never built anything before in my life, folks. I never built any schools. I had never built a house. I didn't have brothers or sisters that were in the construction business. I didn't have an uncle in the construction business. Folks, I had no one in my circle of friends that had built a commercial space from the ground up. So this was a completely new territory for me. But what I love about the SBA 7A loan is the way that they funded the project. They would send their own people to confirm that the construction company was delivering the product as they should. When they released money to the electrician, they would confirm that the electrical wiring and all of the necessary cables and outlets were done according to code and according to the plan. They would confirm that the plumber had done the work that he was supposed to do in alignment with the business, with the plan, the architectural drawings, and the building department's approval. As they released the money to the contractor, I felt like I had somebody else backing me up, especially since I was doing this by myself. I wasn't married. I didn't have a husband that was in a construction firm that could go there and kind of give that deep voice and, advocate for me in a way that construction and men can have a dialogue between themselves. It was just me, folks. It was really, really interesting. I mean, I still remember standing there with my father as my support, and he comes from education. He's actually retired as vice principal from elementary school. And all these men around me doing a fire extinguisher check. They were looking at the fire extinguishers. They were looking at the various nozzles and the pressure of the water and how the building was properly set up. And my plumber was not there on time. And boy, I got ringed for that. I just smiled. I said, I get it. I am the owner of this project. I am GCing my own project, meaning that I was the general contractor for my project with no experience. So you can see why having a 7A loan was ideal for me because I could just blame the bank and say, listen, they're not going to release the money unless you complete this part of the project or this part of the blueprint. It was a great way for me to have support while I ensured that the school was being built according to plan. The maximum amount was $5 million. you need to put a down payment of 10 to 20%. So even though I had 10% of the money, when it asked me for additional down payment, that's where the equity line of credit on my property came in. I was able to draw from my equity on my property to then be able to meet the additional down payment that was being asked of me. So having a real estate is really important. And that's why I said owning a group family daycare is the sweet spot, because you own the real estate, you have a business, you're already building equity. So if your goal is to open a center-based program where you have to go ahead and build out the school, you have a 7A loan that's right there to meet you where you are. You're able to get a variable or fixed interest rate. It's up to 25 years. They'll release the funding as the project progresses and meets certain milestones. You get an SBA approved lender. And yes, it covers ownership changes. And yes, it has working capital. You can use it also to buy an existing childcare business. So if you see a childcare business that the owner wants to sell, you get pre-approved for an SBA loan. Go out there, show your pre-approval. And now it's just a matter of going through the due diligence and ensuring that that particular seller is aligned with you and is willing to sell you the childcare center. Does that make sense? So that is how you're able to work through an SBA lender, and why that SBA loan was important for me, because I wasn't buying the real estate. I appreciated the working capital, and it gave me money to build out the school and also purchase equipment. And equipment is extremely expensive. What are non-traditional pathways? We kind of touched on this. We talked about the whole life insurance policy. You can borrow against your policy cash value. There is no credit check, no approval process. Interest accrues, but the repayment process is very flexible. And the policy continues to earn dividends even though you borrow against it, which is fantastic. You're still earning money on your cash value policy even though you borrow against it. And you can decide the payment plan for paying back the loan, which is also very, very good, and a way for you to have a little bit more control of how you build your program. The 401k, you have a rollover for business startups. You can use retirement funds to buy a business without early withdrawal penalties. It requires setting up a C Corp and strict IRS compliance. So although this has strict IRS compliance and they want you to open up a corporation, it still allows you to withdraw without having to have the penalty, which can be high. A penalty for early withdrawal can be as high as 20%. Imagine you're borrowing 100 and just giving away 20% because you didn't properly structure how you were going to withdraw that money to apply it to either buying a home or purchasing a business. We talked about the community development financial institutions, which are called CDFI. They offer loans to childcare providers in underserved areas. So if you're in an opportunity zone, like in New York City, we have 304 opportunity zones in New York. And in those opportunity zones, there's childcare deserts. You can therefore go to these underserved communities, look for a community development financial institution, and partner with them to fund you to open a childcare program. And they're more flexible in their underwriting than traditional banks. And you want that, somebody that can understand your business and what you're bringing to the community. So you have a really good opportunity here with community development financial institutions. Let's keep going. As we talk about the next ways that you can fund your business, I want you to please like and subscribe below. Your subscription to this channel allows me to provide you with more information. It changes the algorithm and allows the information to filter to the top, to float to the top of your inquiries and other individuals that are looking for information like this. Being part of Decoding a Childcare Business family is a way for us to connect about real issues that are important to you in pursuing the dream of opening, building, and growing your childcare business. I need you to subscribe and like below, and I want to thank you in advance for doing so. Let's go right back to the program and continue discussing ways for you to be able to finance your dream of opening, growing, and expanding your daycare or childcare business. Expansion grants. State and local governments offer capacity building grants for childcare. These do not need to be repaid, but often have strict usage and reporting requirements. These expansion grants are very good, but it is important for you to understand that to participate in some of these grants, you have to have really good financial books. You have to be sure that you are accounting for your revenue, that you're paying your taxes, that this information is being recorded. So you want to make sure that you're recording all of your monies, because by doing so, you also open the opportunities of receiving grants. By doing so, you open up the opportunity of receiving grants, receiving funding, and being eligible to also receive lines of credit for your business. Community crowdfunding. You can raise capital through your community or peers, turns investors into loyal customers. If you're looking to open a business, you can open a non-for-profit childcare business, having a board of directors. By having a board of directors, you can also ask to receive grants. The community grant funding can be a tax exempt for them, but there's strict rules and regulations for that. So before you open a non-for-profit, you definitely need to consult your accountant and see if this is a viable way for you to run your business. There are equity partnerships. There are people that will fund you as angel investors, and all they want to do is get a return on their investment. That may be a percentage, or it could be when you sell the business, they want to be made whole with additional capital revenue from the sale. What does that look like? Well, let's say they give you $30,000, and that means they own 1/3, 33%, and you sell your business for $100,000. They not only get back the 30% of their initial investment, but they also may want to have a third of the gross profit. Depending how you structure the return on investment is how they will be able to participate in the profits of the business. Again, this must be consulted with an attorney, and you must be aware that you're already working on very low margins. So you got to think to yourself, not am I school at 80, 100% capacity, but if your school was at 70% capacity, can you still meet your obligation? I'm so excited that you're asking that question, because on our website, www.beyondbasiclearning.com, you can click on the calculator link and start working out your financials to see how much money you're going to need to build a childcare in your community. So don't forget to visit beyondbasiclearning.com and click on how much space do you really need. Use the calculator to start understanding how much space do I really need to start my own childcare business. We're talking about strategic moves. If you already own or rent a home, start a family daycare first. Start a licensed family daycare in your rental property. Use that revenue stream to build savings for a down payment on your home. Then scaffold up to a group family daycare in a larger property you own. You have your real estate, you have revenue, you have ownership, and at the same time, you are building towards becoming an investor in real estate, which adds capital and long-term financial planning to your portfolio. You grow from just being an employee or employer to actually building wealth. And we want to do both. We want to grow our revenue, but we also want our revenue to become a wealth mechanism for our exit plan at whatever time we decide to move on from the childcare business, as I did. I am privileged to be able to open 4 childcare programs and retire from the business that I love in my 50s. This is something you can do too. And these are the steps that you can take that will get you there. If you own, leverage your equity, refinance your home, or take a HELOC to fund the acquisition of a childcare property. Your existing equity becomes the launching pad and also tax deductible. Because if you're borrowing from your home to open up your business or to start a business, you can have a deduction from that initial capital infusion. Again, consult your financial advisor to properly structure that. But there are ways for you to be able to do that will benefit you and help you achieve your dream of growing or expanding your childcare business. Keep your home by the business. You got equity, you got capital, and now you have acquisitions. If you rent, we're talking about a licensed family daycare in your home. If it can grow from a family daycare to a group family daycare, that's the sweet spot. From a group family daycare, and you can still buy another property or rent another property to expand to. You can also go ahead and use the funds and the revenue that you were generating from a family daycare as a down payment for an SBA loan, or to join together with a group development, a community development fund. And a community development fund can help you then move into an opportunity zone to build a childcare center. And that will give you tax abatement and opportunities that you can benefit from. The multifamily play, a sweet spot. Folks, I had a multifamily house. That's what made my opportunity possible. I lived in the basement of my home while the tenants paid the mortgage. That gave me a little bit of working capital to then launch my business and be able to overcome the beginning process of the build out. Having a multifamily home, the sweet spot. You buy a duplex or a triplex. You purchase a multifamily home under an LLC, a limited liability company. You live in one unit, you operate a childcare in another. And if it has 3 units and you rent the third unit and now you're getting rental income, that can do what? It can overlay over your expenses while you ramp up your childcare business on the ground level. You only need 3.5% down through an FHA loan. For owner occupied, you can go all the way up to 4 units. That's amazing. You got 1 mortgage, 2 income streams. Now you have 2 income streams, the rental income and the business. You're living in one, rent-free. You only have to put 3.5% down in a multifamily plan. And I'm going to let you in a little secret. It's a lot easier to buy a multifamily home than it is to buy a single family home. Let that sit there with you for a minute. It's a lot easier to buy a multifamily home than it is to buy a single family home. And that is how I was able to acquire my multifamily home at the age of 25. What happens is that the bank will look at the other unit and the market rate, the market rental rate of the other unit, and consider that as additional income, bumping up what you qualify for. Let me break it down to simpler terms. For example, let's say I bought it let me break this down in simpler terms. When I bought my 2-family home, I was by myself, single. Therefore, I did not need to live in the smaller unit of the house. I was able to convince the lender that I will live in the smaller unit and rent out the larger unit. The lender thought I would live in the larger unit and rent out the smaller unit, but the smaller unit will give me less revenue. So by calculating the fair market value of the larger unit, let's say it's $2,000 a month, times 12 is $24,000 a month. And I made only $50,000 a year. The bank will consider that $24,000 a year into my annual salary, bumping me up from $50,000 to $74,000. That's why buying a multifamily is a lot easier as long as your credit is right, as long as you've done your due diligence, than buying a single family home. Now you have a 2-family home where you can live in 1 unit, turn the second unit into your group family daycare, and folks, you're running. That's the sweet spot. You're running. You are definitely building wealth while building a business. And that is how daycare operators and group family daycare can go ahead and break the chain of poverty of churning 60, 80 hours a day and turn that business into a wealth machine, doing what we love. That's where you want to be. We talked about if you rent, if you own, and the multifamily play, folks. There's a lot of ways for you to reach that dream. What are you waiting for? What are you doing? Have you started? I'm glad that you're listening to me, and I'm so happy that you're following me and subscribing. But now I have given you a lot of ways and opportunities for you to fulfill your dream. You should be able to get started from forming your childcare program to finding ways to understand the market where you want to be. And with this episode, different opportunities to fund your business while building wealth along the way. I'm so glad that we're doing it together. I am here with you, sharing from my own personal experience so you can build your dream, so you can grow. This information, folks, is experiences I personally lived through. And I was able to retire in my 50s from doing something I loved. We can do this together. I want to take a moment to thank you for being here with me on Decoding the Childcare Business. Thank you for watching, and I look forward to seeing you at our next episode. I cannot wait to meet you.